And now there is a recent change in the model law which has come out in November. And therefore, we felt that this is the right manner in which we can come to you with the amended law. This pleasant task of introducing Sunil Bhai. Mr. Sunil Gabawala is one of the best known faculties which we have today. A very learned person. All throughout, he has been a professional practicing in indirect tax since last more than 15 years. He has authored books on service tax. He is representing various industry bodies at various forums, and he has actually been a professional who is interacting with the GST team at the center as well as state from on behalf of various trade organizations as well as various professional bodies to represent the matters. Needless to say that he has given lectures across all organizations in India. He has been one of the best faculty around, and he's currently the secretary of the Bombay Chamber of Tax Chartered Accountants. With this brief introduction, I would now request Sunil Bhai to take over, and I will not be between you and Sunil Bhai because his topic is one of the most important of levy exemption. And over to Sunil Bhai. Yeah, before I give, I would like to perform a pleasant task of presenting a memo to Sunil Bhai.
A very good evening to all of you. It's my pleasure to be speaking on behalf of the Chamber of Tax Consultants on
part of it देखा से
presentation
हाँ okay
a very good evening to all of you. My pleasure to be speaking at the chamber on a very interesting topic of GST. And just yesterday we had a council meeting of GST, and that's where I'm sure there will be some doubts of skepticism amongst all of us whether the GST is likely to come, and this has been there since last 15-16 years. Suffice it to say, we are aware that because of the constitutional amendment, the latest date by which the GST needs to be implemented is 16th of September 2017. And in that sense, I would believe that the time available for the industry and for the governments also to really implement GST is limited. Friends, make no mistake, GST is not a law which is just a change in the tax rate or just addition of a cess or a small change. It's a fundamental change. It's one of the most important changes, as Vikram Bhai was highlighting, post-independence. And that's where what we'll try to look at is some important concepts on GST. And the talk which we will be having over the next couple of hours will rotate around 4 broad aspects of this change. And of course, we'll first try to understand the levy provisions. And before we do that, we might have a couple of slides explaining the broad context of the change, which is basically the need for the dual GST. And then we'll go into the levy aspects of the GST. Thereafter, we'll go into the technical definition of supply. And then we have small topics of exemptions and compositions, wherein we'll be mostly doing a crystal gazing of what's going to happen in the future. So that's where we'll try to spend the next couple of hours that we have. And of course, I've been told that there will be a facility wherein there could be questions which could be asked by you. So please feel free to ask those questions at an appropriate time through the moderator. So let's quickly understand why this big change is required. And those who are into indirect taxes know this very well, that the current indirect tax regime in the Indian context is such that it is full of uncertainties and pitfalls. we have a selective basis of taxation, wherein we have multiplicity of taxes ranging right from excise duty on manufacturing of goods, VAT on sale of goods, service tax on provision of selective services. Of course, the taxable service definition is much wider nowadays, but we still have certain services which are taxed by the state governments. Over and above all of this, we have plethora of local taxes like local body taxes, entertainment duties, luxury taxes. All in all, when you have these types of multiplicity of taxes, each of these tax applies on a narrow concept like a manufacture, sale, service, etc. Moment there is a narrowness in the concept of the charging provision, there is always an anxiety on the part of the industry to try to look at a scenario wherein they do not fit within the definition of manufacture or sale, etc. And at the same time, there is always an overzealous tax collector who would like to interpret that word to cover all types of situations. And that's where governments then try to amend the law and have cover up various litigations which are not in their favor. And we therefore have deemed manufacture, deemed sale, and various associated concepts like that. All in all, we end in a situation wherein industry is totally uncertain, especially on certain types of twilight areas, gray areas, of which tax should be applicable on the transaction. So we have typically an example of a software player who would be so confused on whether he should be charging VAT or service tax that he would not like to take any chances and charge both of them, despite a clear Supreme Court directive that VAT and service tax are mutually exclusive concepts from each other. Now this is where we see lots of complications from the industry perspective. One more challenge from the industry perspective is the fact that there is a cascading of taxes. Because the applicability of tax is on a limited concept like manufacture, sale, etc., the availability of credits for procurements also is limited. And therefore you have every now and then a situation of a service provider who locks his VAT credits, who is not eligible for the VAT credits. You have a situation of a trader who is not eligible for service tax credits, and so on and so forth. So moment you have this cascading impact, it adds to the final cost, it adds to the inflationary pressure in the economy, and it also starts interfering into the normal tax structures. You have manual processes at each state. There are different documentation requirements. Some states have waybills, some states have road permits, and each of them has a separate process in which these documents need to be obtained. All in all, not a very optimistic or a very nice step way to do business. And that's where we look at the international rankings, we find that in the ease of doing business, India has a very low ranking. And that's where around 15 to 17 years back, we started with this journey to say that we should find something simpler. And we started our journey towards finding the best practices from the international perspective. And when we did that journey, what we found was that quite a few countries in the world have a comprehensive taxation on indirect taxes. So there is a common definition of a supply which is very wide. We do not go into hand picking concepts like manufacture, deemed manufacture, sale, deemed sale, service, etc. We give a very neutral definition called supply. And moment there's a supply, moment there's an invoice raised, there's a tax, and that tax is generally known as single tax, known as goods and services tax in most of the countries. Some countries like the EU name it as VAT, but most of the other countries name it as GST. And that tax is generally therefore creditable across the chain. There are seamless credits available, and that's the word which is generally used, and there are automatic processes. Now this is where when we started the journey, we said that this is the best practices in the world, and this is what we want to bring into our country as well. And when we started this discussion, we realized that, well, because of multiple stakeholders in the country, we perhaps may not be in a position to achieve this objective. We realized that in India, we have multiplicity of governments. We have the central government, we have the state governments, and this is a federal structure where the constitution guarantees certain rights and powers to both the central as well as the state governments. In that scenario, trying to bring in a single tax was something which the state governments were not willing. And there were two broad constraints or objectives from the state government's perspective. The first one was the revenue concerns. Each of the state governments has its own expenditure budgets, and necessarily they have to fund those expenditure for the various states. On this aspect, the central government went a step ahead and said that if revenue is your constraint, what we can do is we can collect the tax and then share the taxes in such a manner that you are assured of your revenues, and that for that you don't need to really have a complex tax structure in the country. But revenue was not the only important constraint. A larger important constraint was the fact that each of the state governments wanted to have an autonomy. They wanted to have a power to legislate, the power to define the exemptions, a power to define the rates, and a power to oversee the assesses within their jurisdiction. And that is where the whole journey towards the GST was time the date was getting extended from time to time. This is where at one point of time, the stakeholders took a conscious decision that if this be the scenario, we will never have GST. And that's where we said, let best not become an enemy of better. If we try to bring a single GST, which is the best practice, we will just not reach anywhere and we will be stuck with the current myriad of taxes which exist in the country. So, as a grand compromise, the country took a position that let's try we should still embark upon that journey. And that's where the country agreed on what is known as the dual GST concept. We have this concept, and this is the proposed GST regime, wherein we are on a point of no return. The Constitutional Amendment Act has very clearly defined the framework, and that framework is that we will have a dual tax, which basically means that while there will be a comprehensive taxation on all supplies, and we'll be going into the definition of the term supply in a few minutes, it would still be at a dual level. Media keeps on flashing one nation, one tax, but as professionals, we very clearly understand that this is not a scenario of one nation, one tax. It's actually one nation, multiple taxes. Right now, we'll just start by saying it's a dual tax, which means the central government will levy a tax on all supplies, and at the same time, the respective state government will also levy a tax on all supplies. So, on the same taxation base, which is a supply, on the same value of that supply, both the central as well as the state governments will impose a tax. The central government collecting the tax known as CGST, and the state governments collecting a tax known as SGST. And therefore, when we look at a rate of 18% of GST, what essentially we talk about is a 9% CGST plus a 9% SGST. For simplicity, we always use the word 18% GST, but at an actual level, you have two layers of it, two different tax payments, one tax payment known as CGST, one known as SGST. Both Siamese twins, they go hand in hand. Both of them exist simultaneously, but both of them do not crisscross each other, which means your CGST is not substitutable against SGST, and an SGST is not substitutable against CGST. And the moment you have a dual tax which comprehensively applies on all supplies, you end up with, of course, unrestricted credits, but at the same time fragmented credits. Because as I was highlighting, C cannot be substituted against S cannot be substituted against C. And therefore, you will still end up in a situation of maintaining parallel tracks and adjusting credits in a manner wherein there will be fragmentations. You might have a situation where you might have CGST credits lying, but an SGST output tax, and that credits cannot be adjusted against the SGST output taxes. More importantly, because of the dual GST concept, we also are looking at a situation of a geographical fragmentation, and I'll be talking about it a little bit later when we go to the concept of brand transfers. While we are doing all of this, we also realize that once you bring in a dual GST concept, there will have to be a seamless credit. And when we talk about seamless credit, we mean also a situation of a tax paid in a state like Kerala being available as a credit to a state like Jammu and Kashmir. Now, when you are trying to bring this type of a situation in a country which is as diverse as India is, we need to ensure that there is no possibility of a misuse, no possibility of a fraudulent claim of credit. And that is where we have a very important role of the IT network in the country. Infosys has developed this GST portal, which is now at a testing stage and would soon be opened up even for the transactional testing purposes. As of now, it's opened up for registration and migration, and slowly in phased manner, that portal will be opened up for various other purposes. So this, friends, in sum and substance, is my general understanding of what is a dual GST concept. Let's quickly look at what all taxes go away. And that's where you see there's a lot of consolidation. When you look at the central level, today we have a central excise duty, a service tax, various additional excise duties, countervailing duty in case of imported product, and a mess of cesses, a whole range of cesses right, ranging right from education cess and going all the way to Swachh Bharat cess, Rishi Kalyan cess, all of them subsuming and becoming a part of a single central levy known as CGST. At the state level also, we have a huge level of consolidation. The major tax which gets subsumed within the SGST is your value added tax. Of course, if for interstate transactions, there's a CST which also goes away. When you watch movies, there's an entertainment duty that goes away. While I'm saying this, there's a star marks which applies, which says that if there's an entertainment tax levied by a local panchayat or a municipal corporation, that is likely to continue. However, the general state level excise entertainment duty gets subsumed into the SGST concept. Interestingly, and as a big relief to people who are in Bombay or in a nearby area, there's an octroi duty for every product which enters into the city or limits of Bombay. That octroi duty is getting subsumed. In certain states, you have entry tax and local body taxes. All of them also get subsumed. When you stay in a hotel, there's a luxury tax, which also is getting subsumed into the SGST concept. So when you look at this, you see that at the state level, there is a huge consolidation and many important taxes are getting subsumed into the GST regime. So around 13 to 14 taxes going away and getting replaced by two taxes known as CGST and SGST. Now when we talk about C and SGST, we immediately acknowledge the fact that this is a state level tax, and moment you bring it as a state level tax, the challenge which comes is that you have multiplicity in the world, while most of the countries, around 160 countries across the world, have a dual as a dual GST concept, only 5 to 6 of them have dual GST concept, and this IGST concept is unique in the world. Nowhere else in the world we have this concept called IGST, a very unique concept wherein we are trying to ensure a seamless flow of credit without making a blockage of working capital requirements into the cash flow by way of unavailable refunds. So that is what IGST tries to bring. And what we therefore try to do is, when case of interstate transactions, when a transaction flows across multiple states, IGST substitutes itself for C and SGST. Integrated GST will be levied instead of C and SGST. And the thought process is that the IGST will have two components, the central component and the state component. As far as the state component is concerned, it will be available to the destination state, and therefore the destination state will be able to give a credit if it is otherwise eligible to the buyer. And that is where we say that this will essentially help in maintaining the tax chain and maintaining the credit chain, then therefore result in a seamless flow of credit. So essentially we are using three words till now. We are saying for any transaction of a supply, and now we become agnostic to the nature of the supply. It can be a supply in the nature of sale, it can be a supply in the nature of service, it can be a supply in the nature of a combination of the two, it could be anything. So long as there's an invoice raised and that supply spans within a state, which we will now say is an intrastate supply, there will be a combination of CGST and an SGST. If it's an interstate supply, if there will be an IGST, the rate of IGST will be equal to C plus SGST total, and therefore at an overall level I remain agnostic to whether I buy interstate or intrastate. Of course, the state component of IGST will go to the consuming state, to the destination state. So this is the broad framework of indirect tax dual GST concept which we are trying to look at. Some products which are not into the GST regime, are not proposed to be at the GST regime, at least to start with, is basically your liquor and your petroleum products. Certain duties are excluded, as I was highlighting. Entertainment tax and amusement tax levied by the local municipalities continues to be within the domain of taxation. Basic customs duty typically provides a level playing, it provides a comfort to the domestic sector, and that continues. The countervailing duty of course gets subsumed into IGST. Stamp duty would continue, so the real estate will have challenges on that, and electricity duty is going to continue. Of course, there are certain other indirect other taxes which are not really the nature of indirect taxes, but many times we get questions. So to answer that, yes, your securities transaction tax, commodities tax, toll charges, which is technically not in the nature of a tax, property tax, all of them would also continue. So except the 14-15 taxes which you just talked about, some of the taxes would still continue. So let's look at how dual GST spans out in case of various scenarios. So we have a situation wherein we start a journey of a product which gets imported into the country and look at the entire supply chain till the stage some part of the product actually moves out of the country also. So let's take the first example. Whenever a product is imported into India, along with the basic custom duty, there will be a countervailing duty, and that countervailing duty will be equivalent to the IGST rate which is applicable in the country. So the moment a product crosses the customs frontier and reaches the Indian territory, an IGST imposition will be there, and that IGST, of course, for the business will be available as a credit. After importing the product, the importer might sell it locally within the same state. So you have an importer in Maharashtra who imported the product and then sells it to another trader in Maharashtra. This will be defined as an intrastate supply. It would be liable for a combination of CGST as well as SGST. Now, very interestingly, under the input tax credit provisions, we are told that IGST is a tax which is fully fungible, and cross-utilization of credits of IGST against C and SGST and vice versa, C and SGST against my output of IGST will be allowed. And therefore what would happen is this importer will adjust the IGST which he pays on the import of the products against the liability to pay CGST and SGST. Essentially, therefore, he will end up paying by way of cash only a tax on his net value addition in this entire process. And that's where we see that there is a seamless flow of credit. The IGST immediately gets adjusted against C and an SGST, in contradistinction to today's scenario where specifically the SAD which is charged to the importer at the time of import, he has to file a separate refund claim and then wait for the money to come back from the customs authorities. And that's where traders would find, traders would find a huge advantage in this type of a scenario. So that is the first journey which we talked about. Post that, the trader again further sells this product to some another person in Madhya Pradesh. And this is where we see that the product now moves from one state to another. This will be characterized as an interstate supply. As we talked about earlier, such interstate supplies will be liable for IGST. So this trader will now charge IGST for his sale which he makes from the state of Maharashtra to a supplier in Madhya Pradesh. When he has to pay this IGST, he will be in a position to claim a credit of the local taxes, which is the CGST and the SGST, which has been charged to him in the Maharashtra state. And therefore, again, as far as this trader is concerned, he also will end up in paying only a tax on the value addition in cash. The balance tax will be paid by availing of the credit and cross utilization of the C and the SGST credits against his output IGST liability. Now the buyer in Madhya Pradesh further sells that product within the state of Madhya Pradesh. Necessarily that becomes a local intrastate transaction, and there will be a CGST and an SGST of Madhya Pradesh. For paying that, again he will be able to utilize the IGST credit which has been charged to him by the Maharashtra supplier. So when you look at this entire chain, the end product ultimately gets consumed in the state of Madhya Pradesh, and the state component of the tax goes to Madhya Pradesh government. Of course, in the interim, the taxes are collected by various governments, and that's where you see IGST acting as a bridge. At one point of time, the state GST was a local tax of the Maharashtra government. It got recolored as IGST, and through the bridge of IGST, it got recolored into a local tax of Madhya Pradesh government as the product flew from the state of Maharashtra to Madhya Pradesh. So this is the general supply chain, and suffice it to say, we've talked about imported product. A similar supply chain exists even in case of a domestically manufactured product. The example would be more or less similar. Now when we talk about this, there could be one more scenario, and especially in case of manufacturers, this would be very common, that they would have a factory in one state and they would have depots in multiple states. And that's where you might end up in a situation that the taxes on the raw materials or the procurement would stick into a state. And to address that issue, we are told that whenever this product, after being manufactured or processed, moves from one state to another, otherwise than by way of a sale, meaning by way of a branch transfer, we want even the tax to flow along with the tax, along with the product. And therefore we are told that even though this transaction is not a sale, even though it is a self-supply from one branch to another branch, there is an artificial dimming fiction, and through that artificial dimming fiction we are told branches of the same company in different states are treated as different assessees, different taxpayers, and therefore there will be a deemed tax on this transaction which will be in the nature of an IGST. So essentially, if you continue this chain, there will be a IGST paid at the time of transferring those goods from the warehouse in Maharashtra to the warehouse in Gujarat. This IGST can be paid by utilizing the IGST on the import stage, and therefore again, just like you had a normal sale transaction where effectively you paid tax only on value addition, here also you will end up paying a tax on value addition and at the same time flowing the entire credit which was stuck into a state into another state. And thereafter, necessarily, when that warehouse sells goods within the state of Gujarat, they would charge local taxes because it would be an intrastate supply in the form of C and an SGST. Against this C and an SGST, they would cross utilize the credits of the IGST input credits which were available on account of brand transfers, and therefore again there is a smooth flow of credit. Of course, when a product is exported from the country, we do not want to export taxes. So we are told that when the product flows outside the country, there will be covered by the IGST law, but there will be a zero rating mechanism, which typically means that the exporter will not end up paying an output tax, but at the same time would be eligible for a refund or a self-adjustment of credit of all the input taxes associated with it. So this is how the entire dual GST matrix will frame out in the future, and that's where we see that yes, you will have a free flow of credit. To ensure this free flow of credit, we are talking about three broad legislations: the CGST Act, which will administer the central GST component by the central government; the SGST Act, which will be for the state GST calculations and collections; and in case of interstate supplies, we will have the IGST Act. Now, as a policy, IGST Act is supreme because the Parliament has decided, the Constitutional Amendment Act has given the powers to the Parliament to determine what is interstate supply and what is intrastate supply. As far as intrastate supplies is concerned, the central government and the state governments are free to decide the rules and the regulations in their own manner, of course, subject to the recommendation of the of the GST Council. As far as interstate supplies is concerned, the principles will be decided by the Parliament. Of course, the state component of that tax will flow to the state government, which is the destination state. So we now go into the levy provisions, which are the respective provisions in these specific laws. So you have section 8.1 of the CGST and the SGST model draft laws. As Vikram Bhai was highlighting, we already have two versions of the model GST law. The first version was recommended by the empowered committee of the state finance ministers, because till that time the constitutional amendment bill was not enacted, and therefore the empowered committee of state finance ministers in June came out with a model GST law for the industry to read and make comments. The way it was drafted, it was more potpourri of the three existing laws, picking up not all the best features of the three laws, but maybe the bad features of the three laws, and therefore the law became appeared to be more complex than what it currently was. Lots of people represented, and based on various recommendations, around more than 4,000 substantive recommendations were received by the governments. They amended the law, and the second version of the model GST law was again presented in November. This was presented again by the Secretariat of the GST Council. It is still going rounds of discussions amongst the GST Council, but this was presented by the Secretariat of the GST Council in the end of November. And this is the law which we are going to talk about. Please note, this again is a draft law, and as I generally speak in all my presentations, whatever I speak has an expiry date of today itself, because in the next council meeting they may again undergo some changes, and till the time it's final, whatever we discuss, we'll have to just understand it broadly from the conceptual angle rather than trying to interpret each commas and full stops of the provisions. So with that background, let's read the levy provision, which is section 8.1 of the CGST and the SGST Acts. Here we are told, okay, I've been told that if somebody has a question, there's a mechanism to, you can type the question on the chat box and it will be visible to me, and I'll try to deal with it in the in my session in the respective slides as we move on, or towards the end, depending on what type of the question is. Please feel free to put your questions into the chat boxes at a relevant time. So coming back to the levy provisions, we are told section 8(1) of the CGST and the model SGST Act provides for the levy of a tax, and we are told there shall be levied a tax or the CGST or the SGST Act tax on all intrastate, and this is the key word here, on all intrastate supplies of goods and or services. So we have three keywords up here, all intrastate. So we'll have to decide what is meant by intrastate in contradistinction to what is meant by interstate. We'll have to then define the length, breadth and the boundaries of this word supply, and that definition is going to be very important, and we will have to see its interpretation settle over the next couple of decades. Thereafter we have of goods and or services, and this essentially brings the comprehensiveness of the GST regime. It basically says that we do not care about whether a transaction is that of goods or that of services, or maybe a combination of goods or services. And on the value determined under section 15, so valuation is also integrated into this provision, and at such rates as may be notified by the central or the state government in this behalf, but not exceeding 14%. So this is one of the demands which the opposition parties had, and the government is trying to address that by having an upper cap in the legislation itself to say that the rate will not exceed 14%. Now please note that whichever rates which we talk about in these legislations by itself, therefore when you say 40 not exceeding 14%, it essentially means 14% CGST and 14% SGST, taking the effective upper cap of GST to be 28%. And as you are aware, in the rate, the GST Council in one of the meetings had brainstormed on the rates and have come to a consensus that there will be a 5 rate structure ranging from 0% for essential commodities, moving all the way to 28%. And that gets reflected into this levy provision in the mention that yes, the rate will not exceed 14%. So these are the key words which we will have to bear in mind when we look at the CGST and the SGST Act. We'll have to talk about the levy, which is essentially on all intrastate supplies, and therefore we'll have to go into supplies. We'll have to understand the comprehensiveness of the levy, and then go to the valuation and the rate provisions in this regard. As far as IGST is concerned, the language is more or less similar, except for the fact that instead of intrastate supplies, we will be using the word interstate supply. So let's therefore straight away jump into what is meant by intrastate supply. Now, as I was highlighting earlier, while we have a separate legislation called C and the SGST law for intrastate supplies and a separate legislation for interstate supplies, the principles to determine what is intrastate or interstate is a domain of the central government, a domain of the parliament, and therefore the definition of intrastate supply also is provided by the IGST law. It is not provided by the C or the SGST enactments, and that's where we straight away jump to section 4 of the IGST Act, which defines intrastate supply, and then necessarily this definition gets adopted into the C and the SGST regimes. So what we are told under section 4, and this has two parts to it, subsection 1 and subsection 2. Subsection 1 would deal with goods, whereas subsection 2 would deal with services. And while we say it's a goods and a services tax, for various reasons, we still define or classify supplies as either supply of goods or supply of services. And we have elaborate provisions on the nature of supply, which of course we would not be going into too much detail. But suffice it to say that yes, various provisions we have to read separately for goods and for services. So let's understand what is intrastate supply of goods. So we are told, subject to the provisions of section 7, intrastate supply of goods means any supply where the location of the supplier and the place of supply are in the same state. Three keywords: location of supplier and the place of supply and same state. So what we are told is whether something is intrastate supply or not will be determined by a combination of the location of the supplier and the place of supply. Location of supplier is the place where you as a supplier are located, the warehouse or the factory where it is located, from where the supply is being made, and the place of supply is very loosely put, the place where the customer is located, the place where the supply is destined towards. So a combination of the location of the supplier and the place of supply would determine whether the transaction is that of an intrastate supply or that of an interstate supply. So that is where you see section 1 in contradistinction to the next section, section 5.1, which we will be talking about, which would define interstate supply. Of course, there are carve-outs, and these carve-outs are important. We have given two carve-outs. We are told that through a proviso that the provided that the intrastate supply of goods shall not include a supply of goods to or by a SEZ unit or a developer. Now, this is an important carve-out which has come in the second version of the GST law. It was not there in the original law, and that's where many SEZ units and developers were under a state of suspense of what would happen to their exemptions. Even today, in as far as SEZ taxation for indirect taxes is concerned, we have exemptions in excise and in service tax law, of course with certain conditions applicable to it. As far as VAT is concerned, some states provide a zero rating to SEZ, some states do not provide. And that's where all the SEZ units were a little bit concerned when this proposal of merging VAT and service tax into a common levy called a GST was being thought about. When they did not see a reference to SEZ in the first model GST law, they felt that perhaps states would have dissimilar thought processes and they would end up paying taxes. And that's where through various representations, it was made clear to the government that SEZ has certain advantages and those advantages should continue. Better sense prevailed, and in the second GST law, we have this carve out wherein we are told that intrastate supply will not include supplies to or by SEZ units. So essentially, we are taking supplies to SEZ outside the purview of the domestic taxation, taking it to the IGST law, and under the IGST law, there is a provision for refund to be given to the SEZ units and the developers, and therefore there would be a uniformity. Any supply, even if the location of the supplier and the place of supply is within the same state, yet it would not be treated as an intrastate supply, it would be treated as an interstate supply and would attract IGST such that a common IGST refund can be claimed by the SEZ unit. Second aspect again is a technical aspect wherein there was a challenge about a levy of VAT or GST in the future on goods which are lying in a bonded warehouse and sold from a bonded warehouse. So the challenge which was coming under the GST regime was, in this situation, the location of supplier being the bonded warehouse in the territorial waters of the country and the place of supply, which is the customer's location, both of them being within India, there was an exposure towards taxation, though the goods had not intermingled into the domestic landmass of the country. And therefore, to address that situation, the second carve out has been given. We are told that supply of goods brought into India in the course of import till they actually cross the customs frontier of India will be governed by the interstate supply and not by intrastate supply, even though the bonded warehouse and the place of supply, both of them are located within the same state. So with these two carve outs, we find that generally, if the location of supplier and the place of supply are within the same state, it would be treated as an intrastate supply. Similar provision exists for place of supply for services as well. Again, a carve out for SEZ supplies of services. Necessarily, there is no question of having a bonded warehouse in case of services. So therefore, the second carve out is not required in the definition of intrastate supplies. And that takes me to interstate supplies. And what we are told in interstate supplies, and we'll see lots of changes over here. And there are 7 specific situations which we are trying to address in the concept of interstate supply. And each of these is defined to be interstate supply. Some of them would have a tax implication, some of them are given exemptions, and there are distinct tax treatments to each of them. And therefore, we'll deal with each of the subsections separately. And when we try to bunch these subsections, we will find that there is some flow in these subsections. The first 2 subsections deal with a normal scenario, and they are actually contradistinctions to our earlier scenario of definition of intrastate supplies, wherein the anchor point was the location of supplier and the place of supply being in the same state. Similarly, here, if you look at subsections 1 and 2, we are told that if the location of the supplier and the place of supply is in different states, it will be treated as an interstate supply and will be subjected to IGST levy. Now, of course, subsection 1 deals with goods, subsection 2 deals with services. And of course, the tax will flow to the state where the place of supply is located. Of course, I have not gone into what is place of supply. That could be a topic in itself, but suffice it to say that the general proposition is the destination of the goods, and in case of services, it is the location of the service recipient. But when I say this, please note this is subject to many conditions apply, many asterisks. There are n number of exceptions to this general rule, which would be, I am sure, a topic in itself with the chamber will consider for one another session on webinar at an appropriate juncture. So this is your subsections 1 and 2, which deal with the situation of defining an interstate supply based on the combination of location of supplier and place of supply. Subsection 3 and deals with the situation of the carve out which we talked about in the intrastate supply definition. Supply of goods in the course of imports till they cross the customs frontier. And subsection 4 deals with the physical act of importation. And of course, it also talks about services. And that's where we have situations of both of these being treated as imports. As far as goods is concerned, the tax will be levied as a countervailing duty along with the basic customs duty, of course, and it will add come into the normal GST credit chain. As far as supply of services is concerned, today also there is a service tax on import of services. Similarly, there will be an RCM on import of services under the GST regime as well, with a corresponding credit chain working on the same. The fifth situation is an interesting situation. We have a mirror image of import, wherein we talk about a location of supplier in India and the place of supply outside India. So typically when you export your goods, it would get covered here. Export of services would get covered here. And both of them we are told will be zero rated. There's a very specific section under the IGST Act dealing with this type of a scenario. 6 is supply of goods and or services to or by a SEZ unit or a developer. It is deemed interstate supply, wherein the taxpayer will collect the taxes from the SEZ unit, who will then go to the government and get a refund, and therefore effectively there will be a zero rating for that transaction as well. And then we have a subsection 7, which is a sort of a residuary provision, which talks about supplies which are made within taxable territory, but which are not intrastate supplies under any of the 30 or 31 state legislations. Now, this is a very interesting proposition under the GST regime, wherein we have the concept of taxable territory to be India, which not only includes the federation of the states and the union territories, but also the extended continental waters. Now, when you look at the specific definitions of the states, there will be 30 states, and you will find that the taxable territory is really not a sum total of my 30 states. And that's where the first model GST law presented challenges in case of supplies which are happening within union territories without legislature, something like Daman or Silvassa, Andaman Nicobar Islands, Lakshadweep Islands, or maybe supply of services or goods at the extended continental shelf. So today you have a lot of activities happening at the Bombay High in the extended continental shelf. So the challenge which was coming was because the definition of intrastate and interstate supply was anchored on the definition of a state. And since these territories did not constitute a state at all, the entire law, the legal framework was collapsing. And that's where we have this 7th subsection which tries to address this situation. It says that if there's any supply within the taxable territory of India, India, of course, as we understand, is the extended definition of India which has been provided under the model law. And if it is not within any of the 30 states, it will compulsorily be interstate supply. It's a deemed interstate supply, and there would be an IGST applicable on those types of transactions. So this summarizes the overall context of the levy provisions, wherein we say there is a combination of C and an SGST for intrastate supplies and an IGST levy for interstate supplies. To decide whether a transaction is an intrastate or an interstate supply, we typically look at the location of the supplier and the place of supply. If both of them are in the same state, then it becomes intrastate, and if both of them are in separate states, it becomes interstate. Now, interestingly, there's one more dimension to this entire aspect, and the fact that place of supply rules are more or less linked on the location of recipient. Being a destination-based tax essentially brings in the third interdependency to say that the place of supply would ideally be the location of the recipient, and therefore, depending on the combination of the location of the supplier, location of the recipient, and the place of supply, and subject to various exceptions, you might end up in different types of solutions in the levy provisions itself, some of them becoming a C plus SGST, some of them becoming an IGST. And when you are looking at that, necessarily you will, as you can see, there's a lot of emphasis of the place of supply moving towards the location of recipient, which means typically it's a destination based tax, but there are certain source rules, there are exceptions. For example, when you stay in a hotel, then you are told it's the location of the hotel which will be important to determine the place of supply and not the location of the recipient. And that's where you see some shades of yellow taking the interdependency from the place of supply closer to the location of the supplier rather than the location of the recipient. So that's where you will have a complex set of permutations and combinations of the place of supply rules, which will be taken care of at a separate session in itself, not in this session. So this explains my first discussion on the levy provision. And again, I'd like to repeat, if there are questions, please feel free to put those questions at an appropriate stage into the chat windows and we'll deal with them. Now that takes me to the second important area of discussion, which relates itself to the definition of supply. We've talked about the levy of GST. Let it be CGST, SGST or IGST. The levy of GST is on this word called supply. And that's where we will have to now understand what is meant by supply. We are given a technical definition of supply. Supply is defined under section 3.1. We are told supply includes all forms of supply of goods and or services. Now this is where we see the first challenge in the definition. This is the heart of your GST. Supply is the anchor point on the basis of which GST is imposed on an organization or on a taxable person. And we are told that definition itself is given an inclusive definition. We are not given an exhaustive definition. So while ABC would give us an indicator of what is a supply, it is not an exhaustive indication. If something does not fit within ABC but would meet the traditional corners of the word supply, it would still be a supply. And that's where we'll have to be careful in interpreting this definition because it is inclusive in nature. So we are told supply includes all forms of supply of goods and or services such as sale, and then we have a long list of examples over here. We are told that these examples of supply should be made or agreed to be made. That's come from the service tax regime wherein there's a taxation on advances and we want to continue the taxation on advances. Therefore, you said made or agreed to be made for a consideration. So if you look at subsection A, a consideration is a sine qua non. It's a most important requirement for any transaction to be called as a supply by a person in the course or furtherance of business. And this is for the first time that we have this context of saying that the supply should be in the course or furtherance of business. Of course, business itself is defined and we'll go into that definition in the next couple of slides. But this gives some sort of a boundary to the definition of supply, which in services we have never understood. In services, we never have had this type of a qualification that the service should be in the course or furtherance of business. But here in supply, we have that, and over a period of time, the judiciary will have some times in analyzing this phrase in the course of furtherance of business, and maybe the scope of supply may get restricted because of this phrase which has been kept in the definition of supply. Then we have B, which talks about importation of services, because there will be a reverse charge on that. So importation of services for a consideration. Here we are told whether or not in the furtherance of business. Therefore, even a personal importation of service for a consideration becomes the subject matter of GST. How are they going to collect it? That's going to be a challenge. Perhaps when the notifications come out, there might be an exemption for small value personal importations, and we'll have to wait for that exemption. And then we are told a supply specified in Schedule 1 made or agreed to be made without a consideration. And this is where we see challenges, that we are now seeing a situation where one might have a case where there will be a tax without a consideration. Certain types of free supplies therefore become taxable. This is one area where we've seen that the government has been very, very receptive. And when the first model GST law was presented in June, the definition of under Schedule 1 was very wide, and the way it was drafted, it appeared that all free supplies became taxable. Necessarily, this was creating a huge challenge. Many representations went, and in the final second GST law, the revised GST law, there has been a lot of concession over here, and free supplies under Schedule 1, we'll go into that also in a little bit more detail, are now taxed only when the free supplies are amongst related parties or between branches of the same entity. And therefore, a free supply to a third party, an unrelated person, no longer is a deemed supply. And that's why I think a big relief which comes from a receptive government which has understood the pains of the SSE and tried to amend it to some extent. So this is the definition of the supply, and of course some important points from the generic definition of supply which come is whether one can really say that the definition of supply itself is structurally defective because it has an inclusive limb rather than an exhaustive limb. Also, a question which comes is, most of the examples or illustrations given in the definition of supply are in the nature of goods and not in the nature of services, and therefore when you try to apply the definition to certain examples of services, we may not find a very comforting answer. For example, it may not be correct to say that when a person provides a training activity, there is a supply of a training which is made by him to another person. Training insurance, consultancy, various types of services are not made. They are either rendered or provided. Now, to what extent will we be tolerant to these misuses or loose uses of verbiage, in especially in the charging section, is something which the judiciary will have to take a call at an appropriate time. Not going into too much of the structural defects, straight away looking at the basic definition of supply under subclause A. What it essentially means is a satisfaction of 5 important conditions before something can be said to be a supply. It can be any form of supply, either in the nature of goods, services, or combination. The supply has to be made or at least agreed to be made, and therefore advance is becoming taxable. There has to be a consideration for it. It has to be made by a person, and it has to be in the course or furtherance of his business. So let's now go into a few important aspects of it. And the first aspect is, of course, made or agreed to be made. And this is where we will again have to look at whether there's a distinction between made, which is typically used as a word in context of goods, vis-a-vis provided, which is used in the context of services. Again, when you look at scope of the word agreed to be made, one more question which one has to look at is whether this word agreed to be made attaches to a form of a supply or to the levy itself. To give you an example, where when we say agreed to be made, and you read the definition in general, we are told all forms of supply of goods such as sale agreed to be made. So are we really saying that an advance against a supply of goods will be taxed, or does this cover a situation wherein there is an agreement to sell, a formal agreement to sell entered into between two parties? This is again something which will have to be legally interpreted at an appropriate time. Also, one important aspect is to understand the distinction between an advance and an adjustable deposit, because in the next slide we will be talking about consideration, and over there we have an explanation which says that a deposit will not be treated as an advance and will not be treated as a consideration till the time it is applied towards a particular supply. So let's go to consideration straight away, and we have a definition of a consideration under section 228, a very widely worded definition. We are told consideration in relation to a supply of goods or services includes any payment made or to be made. Now, this is an important deviation from the current indirect tax regimes, wherein the consideration anchor points itself against a charge to be made by a service provider. So today, the word consideration is more service provider centric rather than client centric. But here we are told consideration in relation to a supply includes any payment made or to be made. So it is more client centric now rather than a service provider centric. And we are told any payment made or agreed to be made, whether in money or otherwise, then therefore non-monetary consideration also becomes taxable in response to, in respect of, or for the inducement of the supply of goods or services. So typically your consideration can be before your supply, during your supply, or after the supply. So all the three eventualities, past, present and future, is covered here. Made by the recipient or by any other person. So third party payment also gets covered here. And in the second GST law, we are now of the state government. So government subsidies are outside the purview of the definition of consideration. So this is the generic definition of consideration, and thereafter under subclause B, we add the monetary value of any act of forbearance, whether or not voluntary in respect of, in response to, or as an inducement for a supply. Again, but shall not include a subsidy. And then we have a proviso, where we are told that a deposit, even if it is refundable or not, given in respect of a supply, shall not be considered as a payment unless the supplier applies a deposit as a consideration for the supply. And that's where we have to look at a thin watertight walking between advance and a deposit. The moment you say it's an advance, there is a tax because of the point of taxation rules, the place point of supply rules, which somebody else will be talking about. And if you say it's a deposit, then there is no tax till the time you actually provide the supply and raise an invoice for the supply. While I'm talking about this, companies will also have to take into account the provisions of the Companies Act when they try to characterize an advance as a deposit. So that's where you'll see a tightrope walk coming in there trying to classify this. As I was highlighting, the definition of supply requires that the supply should be in the course or furtherance of business. Now, the word business itself is defined, and it's very widely defined. As you can see, you have clauses A to H, 8 types of situations which we are talking about in the context of business. Again, a very inclusive definition. So anything which is traditionally understood to be a business would clearly be a business. Over and above that, any trade, commerce, manufacture, profession, vocation, adventure, or a similar activity, whether or not it is for a pecuniary benefit. Now, this is important. What we are now looking at is not the end result, not the motive. What we are looking at is the nature of the activity. If the nature of the activity is in the nature of trade, commerce, manufacture, etc., and I'll give an example that if there is a NGO which is selling certain products, in that case that sale would be a trade, the activity of sale is a trade, and therefore it would be liable under, it would be covered under the business definition and liable for GST, irrespective of whether the NGO is doing the sale for a pecuniary benefit or for a charitable purpose. Similarly, any activity or a transaction in connection with the above is also covered here. Any activity irrespective of the frequency or continuity, so even a one-off supply would be covered within the definition of business. Supply of or acquisition of goods including capital assets in connection with commencement or closure of businesses. Then we are addressing mutuality by saying that provision of services by a club to its members will be covered, admission to any premises will be covered, and liquidators are covered in the clause G, wherein we are talking about a situation of services supplied by a person as a holder of an office which has been accepted for the furtherance of businesses. And then finally we have race clubs getting covered under subclause H, and that's where we see that a definition of business is very wide, but yes, there is a definition which will at some time bring in some anchor points or some restrictions on the interpretation of the supply. Now, having said this is a broad definition of the supply, we now have two important aspects to deal with. What happens in a case where there is a composite supply or there are multiple deliverables within a singular supply? For that, we are given principles of interpretation, and there's a classification of a supply either as a composite supply or a mixed supply. So we'll deal with the principles of interpretation and classification first, and thereafter we'll go to schedule 1, which deals with deemed supplies. So here we are told through section 3.5 that the tax liability on a composite or a mixed supply shall be determined in the following manner. We are told that as far as a composite supply is concerned, this is equivalent to something which is like a naturally bundled supply today. And a common example which we are given in the statute itself is a situation where a person agrees to sell a product and also provides a free delivery of the product to the customer. In this scenario, there are two supplies. The first is a supply of the product, and second is a supply of the transportation service. And there could be a common price for it. In that case, it becomes a composite supply. Of course, within these two supplies, there is one principal supply, one important supply, and that being the sale of the product. So what we are told is in this type of a supply, the tax treatment will be the tax treatment of the principal product. And to give you an example, assuming for a moment that agricultural products are outside the purview of GST, and a farmer says that I will sell the agricultural products but also deliver it to you at your house or at your mandi. So there are two supplies. Maybe the transportation supply is not exempted, but because here the principal supply is the supply of the agricultural products, therefore the entire transaction will be treated as being exempted from the purview of the GST regime. This is similar to your natural bundled services under the service tax regime. As a contradistinction to this, we have a mixed supply which consists of two or more supplies, none of them being a principal supply. So you can have a combination of three products being sold in a retail mall, and there is really no relationship between these three products, and it is difficult to say one of them is a primary product. In that type of a situation, we are told that we will pick up the product with the highest rate of tax, and that highest rate of tax will be applicable for the entire transaction. So again, to give you an example, if you have a scenario of a soft drink which is bundled along with, let's say, a fruit juice and a biscuit. Now each of these three products may be under a separate tax regime. This, when you have a combination pack with these three products, it becomes a mixed supply. Now soft drinks, as we know, may be under a 40% bracket. You might have juices which might be under a 28% bracket, and biscuits being daily necessities may sit in the 5 or the 12% bracket. Now then the question comes, if I am charging let's say 100 rupees for all these three products put together, what rate will I apply? And to answer that, we have this mixed supply concept wherein we are told we will be picking up the highest rate of tax. So if in these three scenarios soft drinks is the highest rate of tax being 40%, 28 plus cess, that rate will apply to this entire transaction, and even the biscuits would be liable for 40% unless you are able to split it up and have separate pricing for each of those three products. And that's where one will have to be very careful in ensuring that these mixed types of supplies do not bear an unnecessarily high rate of tax. When we look at these principles, one important concept which comes is what happens to works contracts. And in the second GST law, the definition of works contract has been restored from the earlier or the current matrix of the works contract definition. We are told that any contract which involves activity of work on an immobile property, and along with that there's a transfer of material involved in that immobile property, it becomes a works contract. Interesting to note, there is a deemed supply, deeming fiction under the nature of supply, wherein we are told that works contracts shall be deemed to be services. But at the same time, let's keep in mind that Article 366(29)(a) still exists on the Constitution, and it provides for segregation of goods and services. More important than not, in a works contract there are multiple layers of supplies. Let's take an example of a supply of an air conditioner along with an installation, erection and associated services. And let's say that it is not a case of a sale of an air conditioner simpliciter. In this type of a scenario, the question which comes is, will I treat this supply, which has multiple layers into it, as a composite supply or a mixed supply? It may be a challenge to treat it as a composite supply, because it will be difficult to say that supply of goods is a principal supply or a supply of service is a principal supply. If at all one characterize it as a mixed supply, you might end up in a situation of the highest applicable tax rate coming into place. And that's where you see a challenge in works contract in moving forward also. The whole objective of simplifying the entire regime, perhaps because of the existence of Articles 366(29)(a) and the lack of guidance on the tax treatment of works contracts, one might see that the nightmare or the litigation which is existing in the works contract might continue to some extent in the GST regime as well. And that takes me to the next topic, which is the deemed supply, which is under Schedule 1. And when we look at the definition of the supply, we talked about the fact that there are certain supplies which are deemed supplies even if there is no consideration. There are only 4 of them which are kept, and all of them of course have been kept with a purpose. The first one we are told is a permanent transfer or disposal of business assets where input tax credit has been availed. In the first draft law, even temporary transfer was being taxed, and there was no such condition of input tax credit over here. There now, based on the representation, this is the final law which has come, which is much more favorable. We are told only a situation of permanent transfer or disposal of assets where ITC has been availed on such assets, and this is where organizations will have to be careful of the transition into GST. So as of today, you might have a fixed asset schedule wherein there will always be an extensive list of fixed assets which are already procured and installed by the organization. In all these cases, necessarily no ITC has been availed under the GST law. So at a later point of time, maybe 5 years down the line, when these assets are sold, there is no require or transferred, there is no question of a deeming fiction. Of course, if there's a sale, there's a consideration, subclause A will tax you. But if they are disposed of, many companies dispose of used computers and donate it to various charities and etc. So those types of situations, if ITC has not been claimed, it will not be a deemed supply. Only where ITC is claimed, and necessarily ITC would mean ITC under GST has been claimed, that is the only place where we will have a deemed supply triggering. The second clause is where we are talking of supply of goods or services between related persons, and related persons is very widely defined. Of course, the amendment now provides for at least a 26% holding, but yet it is still very wide, or between distinct persons as specified in section 10. And section 10 basically talks about 2 branches of the same company in 2 different states being treated as deemed distinct persons when made in the course of furtherance of business. So essentially we are saying free supplies between related persons or between branches will become taxable. In all other cases, free supplies will not be taxable. Of course, under the input tax credit provision, there is a reversal requirement for a credit, which again, when you go to credits, you can read that area over there. Then we have entry 3, which talks about supply of goods. And please note, the amendment here, we are only talking about goods. Entry 2 talked about goods or services. Entry 3 talks only about goods. And here we are told goods supplied by a principal to an agent or vice versa, where the other person supplies the goods on behalf of the first one. In both the situations, there will be a deemed supply and there will be a tax. And finally, we have importation of services from a related person or an overseas branch, which will be treated as an import of service and will be taxed even if it is free. So only 4 instances where free supplies would be taxed. And let's start looking at the first one, we are told supplies made through agents will be taxed. The term agent itself is defined in a very specific manner, or a lot of extensive definition which was given earlier has been done away with, and we are now very clearly told a person who carries on business of supply of goods or services will be treated as an agent. Mark my words, here we are using the word supply of goods or services, but when it comes to deeming fiction in the earlier slide, we use the word supply of goods, and therefore even though the agent is very wide, the deeming supply for the agent is restricted only to supply of goods and not to supply of services by an agent on behalf of the principal. So essentially what we are saying is, when a principal supplies goods to an agent for warehousing, maybe the ownership does not pass on to the agent, yet at the time will be a tax at that transaction level, the dotted line which you can see on the presentation, that would be taxed, and necessarily the agent will claim the credit and again pay a tax on the supply at the next level from when he sells on behalf of the principal to the buyer. And therefore, irrespective of the fact that the consideration directly flows from the buyer to the principal, there will be taxation at two levels, one at the agent to the buyer level and one at the principal to the agent level, with corresponding credits at each of these junctures. So that is as far as supply through agents is concerned, and that takes me to tax treatment of branch transfers. A lot of ambiguity existed on this front in the first model GST law. Luckily, they have made it clearer under the new regime. And under the new regime, what we are told is the taxable person is a person who is registered or liable to be registered, and then there are subsections to section 10 which deal with a person having establishments in one state and another establishment in more than one in another state, and we are told that each establishment in each of the states will be treated as distinct persons for the purposes of registration, and necessarily the consequential treatment would be that when there is a movement of goods from one state to another, from one branch to another, it would be treated as a branch transfer, as a supply which is a deemed supply and liable to GST. In a way, this is a silver lining because it enables you to transfer the credits, as we saw in the broad framework towards the start of the session. There is a situation wherein the credits could have got stuck into state A. By making a tax on branch transfers, we are actually allowing a free flow of credit, and we can just take this simplistic example wherein there is a factory in state A, which let's say it's a branch A, wherein there's a procurement of raw material or traded goods. Vendors charge them CS and IGST in state A. All of this could become a credit in state A, and if the branch transfer is not taxed in state B, you end up with just paying an output tax and a huge refund claim in state A. To address this issue, the dotted line is made taxable as a deemed supply, and you therefore end up in a situation wherein you will end up valuing this dotted line maybe at a cost plus method. The valuation rules in this regard will have to come out at an appropriate time. Once there is a tax on this dotted line, you will end up that in state A, you will end up paying a differential tax on the value addition done in state A, and then in state B you will still pay some tax, and therefore the net result is you will not end up with a cash flow issue in this entire process. While this is good and general for movement of goods for further trade, the branch transfer by itself creates lots of challenges in other areas, because the way the law is worded, it tries to tax all supplies of goods and or services between different establishments. It does not restrict the taxability only for supply of goods which are meant for further sale, and therefore you have situation of exposure where you move goods across various branches for various other purposes. You can have your fixed assets, your laptops, your promotional materials, stationery, etc. moving from one state to another, and each of these would attract the rigors of branch transfer taxation. In the originating state, you will have to pay an IGST, and in the destination state, you will have to claim the credit. So far, so good. It's a compliance issue because immediate credits are available. But the larger challenge which we see is in case of movement of high value fixed assets. For example, we are looking at a construction company which regularly moves its equipments like a heavy duty dumpers and earth moving equipment from one state to another. The value of these assets are so huge that paying IGST in one state with a corresponding credit in another state itself is also not a workable proposition, because there would be such a huge cash flow implication that the entity may not have that much cash to pay. More important than that, the interpretation of how do you define a provision of a service by a branch to another branch, that is going to be a challenge, because in case of goods, at least you have a tangibility and a movement trail. When it comes to services, there is no tangibility of the services, and therefore it is subject to a wild interpretation. And just to give you an example, if a managing director sitting in Bombay makes a decision, or in a board meeting the decision is taken about a Delhi branch of that company, can one say that this is a service provided by the corporate office in Bombay to the Delhi branch? And if that is an interpretation which a bureaucrat will take, you will have a nightmare, because how are you going to trail this, how are you going to identify this, and even after identification, how are you going to value that entire transaction? And that's where we see a major challenge as far as branch transfers is concerned. And an associated issue which comes out is related to services. And when you look at services, typically you have many situations wherein there is a consolidated service procurement, and that's where one may primarily look at three possible resolutions. The example if you took earlier was of goods. In services also you can have many services which are centrally procured at the head office, and the service revenues, especially in a banking or a financial company, might arise from the various branches. And that's where we see three possible strategies in which one can look at it. One can obtain an input service distributor registration at the corporate office and pass on the credits to the respective branches. One can interpret that the corporate office is providing a deemed supply of a service, which we just discussed in a minute earlier, to the respective branches. Or one can ensure that there's a split procurement from the vendor. And each of these three resolutions is primarily to ensure an appropriate cash flow mechanism to this entire problem. So let's look at each of them through some simplistic numeric examples. In the first example, let us say the head office in Bombay obtains services from various vendors at the head office for effective consumption by the respective branches. So let's say the tax component therein is 100. By obtaining an ISD registration, the head office can transfer this credit to the respective branches in a manner of 25 each, based on the turnover ratio, which again, when one looks at input tax credit, one can look at the detailed fine print of this. And this 25, which is available as an input ISD distribution to the respective branches, can be offset by the respective branches against the output taxes at those respective branches. So this will ensure a smooth flow of credit through the ISD concept. Second is a deemed supply, wherein one says that I will not use the ISD, I have obtained various services. The head office converts itself into a cost sharing arrangement or a shared service center, and it defines a internal markup or a valuation mechanism. So it procures services worth 100, adds its value addition in terms of consolidation of these services, and supplies services at a value of 27 each to the respective branches, which in turn and cross charges GST on these services, which in turn use it for paying the GSTs on their output taxes. So that is the second possible resolution. And the third possible resolution is that the vendor may be expected to raise specific invoices on each of the specific branches, and for doing this, one can again go to the definition of the location of the recipient of services provided under the IGST Act and try to take shelter over there and say that A Limited essentially is providing services to the respective branches, and the role of HO is merely for the purposes of placement of orders to A Limited and making payments on their behalf. So these are the three possible resolutions which one could look at when one looks at the concept of deemed supply and aggregated receipt of supplies at the head office level. That takes me to the next aspect, which talks about the exemptions and composition schemes. Now both these topics, friends, is a little bit of crystal gazing into the future. We already have some framework in place, but the detailed notification giving out the list of items which are exempted is still not there in the public domain. In fact, the GST Council along with the revenue secretaries are right now sitting around and discussing various situations and trying to finalize this rate schedule. So we'll have to wait to understand what all is really exempted in the specifics in those state schedules. But just to understand the broad concept, there I would believe there would be 4 or 5 broad baskets of activities which would not be liable for GST. And the first one, of course, would be the out of scope supplies. In the first couple of slides, we talked about petroleum and liquor being out of scope from the GST regime itself. And if you are out of scope, then necessarily there is no question of any GST liability on that, and therefore that would be an exclusion from the entire scope of the taxability itself. Thereafter, we have the definition of a taxable person, and the definition of a taxable person requires a person to register and pay the tax only in certain cases. Specifically, there are 2 important exclusions provided from an obligation to register. First exclusion is relating to the threshold limit, and we are told that a taxable person having an aggregate turnover of less than 20 lakhs is not required to register, and this is what is known as a threshold exemption limit, and that would apply across all the services and goods of that person across the country. So this aggregate turnover applies across the country. When we decide this aggregate turnover, please note that non-taxable supplies are now excluded from the purview of the calculation of the aggregate turnover. Uh, while we are looking at this threshold limit, a couple of important things which we need to bear in mind. The threshold limit will not is subject to various conditions. There is a long list of people who are not eligible for the threshold exemption. Notable ones among them, of course, being any person who makes an interstate supply of goods or services. Now, friends, when you look at supply of services, the place of supply of goods are based on the location of the recipient of service, and that's where even at professional level we might see many professional brothers who might be below 20 lakhs and claiming the basic exemption limit. But if they even have one client who is located in another state, he would be constituted as having made an interstate supply. And once he makes an interstate supply, he is excluded from the basic exemption limit. He is thrown out of it. The exemption limit does not apply to him, and he has to pay the taxes. So that is a little bit harsh because there is no threshold available for interstate supplies. Similarly, no threshold is available for supplies which are made through e-commerce operators, supplies which are governed by the reverse charge mechanism. Even persons who are required to deduct tax at source or collect tax at source, all of them are required to register. Agents are required to register on behalf of principals. Principals are required to register if they make supplies to agents. And therefore, there's a long laundry list of people who are not eligible for this exemption limit. All said and done, it's still a welcome move because the initial draft talked about 10 lakhs. Instead of that, now we are looking at a 20 lakh as a threshold. Better than the current regime of 10 lakhs, where both under VAT and service tax, but not as good as your excise exemption limit of 1.5 crores. So those are the concerns which we do have on the threshold limit. When I'm talking of this 20 lakhs, please note that there's a special category of states, specifically the northeastern states, the Uttarakhand, Himachal Pradesh, where the exemption limit will not be 20 lakhs but will be 10 lakhs only. So that also one will have to bear in mind when one looks at the exemption in this regard. Similarly, we are told that an agriculturist who are the agricultural activities will be excluded from the purview of taxable person. The initial GS draft law had a blanket exclusion from for agriculturists, and which was creating certain challenges of and a possibility of a misuse. So to track that, we are now told in the current exclusion, an agriculturist is excluded only who his activities as an agriculturist. So if an agriculturist sells other assets or undertakes other commercial activities, he would be registered and would be required to register and pay the taxes vis-a-vis those activities. It's only the agricultural produce which will be excluded from the definition of the taxable person. Thereafter, we are told that the definition of supply leads to a classification of the supply into either goods or services, and there we have a provision wherein we are told that certain supplies can be defined as being neither goods nor services. This would have a consequential impact that because it is neither goods nor services, they would be outside the purview of the GST regime. And a notable exclusion here deals with employment contracts wherein supplies made by an employee during the course of his employment to an employer would be outside the purview of the GST regime. And we have a huge long schedule wherein specific government activities which are in the nature of sovereign activities, like you have the issuance of a birth certificate or a passport or certain statutory collection of taxes, which are excluded from the definition of goods or services, and therefore those also will be exempted from payment of GST. Thereafter, we have certain supplies which would be liable for nil rate of duty under a schedule, and this is something which will still have to be notified, which will still have to be finalized. If your product is under the nil rate, something like an agricultural product would be under the nil rate of duty, and that would also be excluded from the general understanding of the liability towards GST. And thereafter, the central or the state governments can, through notifications, also grant specific exemptions. There may be general exemptions or there can be conditional exemptions, and even those exemptions would be outside the purview of the GST regime. So these are the 5 broad type of exemptions which we are looking at. And when we look at these exemptions, please note that each of these exemptions comes with a cost, and that cost is reversal of credit at the input stage. And in the GST regime, since there is a comprehensive taxation at the input stage also, you might end up in a situation that there will be a lot of cost attached when you are into an exemption zone. And that's where some people have gone to the government and said that look, exemption is not something which works for us. We want something known as zero rating. And as a concept, we therefore need to understand the distinction between an exempted supply and a zero rated supply. An exempted supply is a supply wherein you don't end up paying a tax on an output, but you do not get credit on inputs. Whereas a zero rated supply is a supply where you not only get the exemption from your output tax, but also get back the taxes on the input. And therefore, the entire supply chain becomes exempted as far as zero rated supplies are concerned. As of now, we are told zero rated supplies will work only in two situations. One is export of goods and services, and second is supplies by SEZ units or by developers. So that are the only two situations of zero rated supplies. All other examples would be those of exemptions by themselves. And that takes me to the last aspect of our discussions, which is relating to the composition scheme. Again, we are told that everybody, we have a 20 lakh limit. Just crossing 20 lakhs makes you liable to GST. Under the GST regime, there is a very complicated mechanism of uploading of returns and matching of credits. All of this is a difficult proposition for a small dealer, and therefore for a mid-sized small dealer, we are given an option of composition to them. The composition scheme is applicable if your aggregate turnover is less than 50 lakhs. So of course, up to 20 lakhs, you are anyways out of the GST regime. Between 20 to 50 lakhs, this is an optional scheme of composition which is given to you. Above 50 lakhs, you are disentitled for composition. So the moment you cross 50 lakhs, you have to forego the composition benefit. Please note that this composition also is subject to various conditions, like what we talked about in the case of the general exemption limit. Similar conditions apply for the composition scheme as well. More importantly, under the composition scheme, you are not allowed to collect the tax, nor are you allowed to claim the credit. So the credit chain breaks both at your end as well as the customer end. It's a simplistic scheme requiring simple returns, but at the same time a huge cost in terms of the tax which has to be paid. So now we are told there's a bifurcation. As far as manufacturers are concerned, they will notify a composition rate which will not be less than 2.5%. So it's minimum 2.5%. And when again I say 2.5%, please note this 2.5% is under the CGST Act. A similar 2.5% will apply under the SGST Act, resulting in an overall total tax burden of not less than 5% for manufacturers. And as far as traders is concerned, we are told minimum 1%, which will take the effective composition rate to at least 2%. The exact rate is still not out. We'll have to see what it would be, but these are the minimum indicated rates under the statute itself. As far as service providers are concerned, we are told they are not eligible for the composition scheme, and this is a major deviation from the original GST law into the revised GST law. And this has to be noted because there are lots of service providers who will be between the 20 lakh and the 50 lakh brackets, and they would not be eligible for the new composition mechanism, which we are going to talk about in the future. So that is the composition scheme, and that from my side summarizes the discussion. I'll just check whether we have some questions, and if there are any, we can take them up. Other questions? How do we know there are questions?
There are questions.
So they come here.
No, I'll just read the laptop. You can read the question and we got the sender and answer.
So we have a few questions.
Function करेंगे. Can you read the question and the sender? Sir, this is the question. This is the name of the person which asked.
So we have a question from Jigar Shah, and we'll take the questions one by one. Quite a lot of questions from Jigar Shah. The first question is whether profession tax will go away or stay. The bad news is yes, the profession tax will stay. It's not going away. It's a tax on employment and not a tax on a supply, and therefore it will continue. The next question is regarding the branch transfer, whether there will be a tax, and you touched upon that in extreme detail earlier. You said that branch transfers would be taxed. The dispatching state branch will have to pay the tax. the tax paid by the dispatching branch will be available as a credit to the receiving branch, and in that and the tax will be known as an IGST. At the time of dispatch of goods, along with the stock transfer note, there will have to be a self invoice which will reflect the value of the branch transfers goods and the tax thereon, which will be available as a credit to the other agency. The next question relates is by Suman Kumar Jha, relates to the valuation on the stock transfers, and necessarily it will have to be at an arm's length pricing. It cannot be at cost. It will have to be at a transfer price, which is somewhere between the cost and the final selling price. And the arm's length principles will apply to determine the correct pricing. We presume that there will be some guidelines which will come out when the final law is enacted on this front. The question by Jigar is whether there will be any additional levy. Initially, there was a talk of 1% levy, but that is now dead. So there will be no further levy over and above the GST. Of course, there is a cess on certain types of seen goods and certain products. If you are covered by those goods, there will be a cess which will come. Again, the rates for that is something which we will have to look at as time progresses. A very interesting question from Jigar Shah, that can the place of supply be different from the location of the receiver? And the answer to this is yes. There are many situations. While in general we say that the place of supply will anchor itself with the location of the receiver, but there are many exceptions to this general rule. One exception which I had highlighted in my talk was regarding a person who stays in a hotel. Hotel is an immobile property related service, and that service we are told will be applicable on a source principle, and therefore if let's say a company in Bombay, an executive of that company stays in a hotel in Karnataka, the place of supply will be Karnataka, even though the permanent address of the company is Maharashtra. So you can have these types of situations, and there is a long list of those exceptions where the place of supply is different from the location of the supplier. One question coming from Suman was, is it advisable to consolidate all the branches in case of a trader and sell from a single state? That is the whole objective of GST, that we are trying to bring in a neutrality of tax positions across branches and across states. Therefore, whether the branches are required or not will purely depend on business decisions. It may be advisable to consolidate. I would say it's neutral. You might like to consolidate, but if your product is such that it needs to be closer to the end consumer, if it's a perishable commodity or something which is of critical importance, you cannot shut your branches, and it will be primarily driven by the business requirements. We have a question from Jitendra Patel, but it seems he is already left, so we'll skip that question. We have one more question which actually spins out from the place of supply, which has come from Jigar Shah. We are told that if an entertainer is asked to perform in a wedding, will he not charge a tax? He will charge a tax, definitely. And an interesting question which is trying to bring is the definition of supply, which uses the word furtherance of business. And friends, make no mistake, the word furtherance of business has to be linked with the activity of the supplier and not with the activity of the client. So if there's an entertainer who is performing in a wedding, it may not be for the furtherance of business of the client, but it is definitely in the furtherance of business of the artist, and therefore there will be a tax on that transaction. We are told aggregate turnover includes non-GST supplies and exempted supplies. Well, the inclusion for non-taxable supplies has been removed in the second GST law, and that's where we will have to see how it stands out in the entire calculation. We have a question wherein we are told that whether we are doing away with the concept of movement of goods. When we go to the place of supply rules, the first rule is anchor pointed around a movement of goods, but in case of a three-party transaction like bill to ship to, we are moving away from that concept of goods, and we are moving into the concept of bill to address in case of 6-2 transactions and bill to ship to types of scenarios. So that is an interesting parameter which we will have to look at. The tax rates are still not out, so while we have an indication that most services would be under the 18% bracket, no specific assurance on at this point can be given on that front. So that's I'm sorry, Kishore, we still don't have enough information on that front as of now. We have a question from Hemant Shah. wherein he talks about a manufacturer located in state A supplying goods in state C, and the recipient is located in state B, what will be the taxability? So I can just tell you that you can go to section 5(2)(a), which deals with these types of bill to ship to situations, and one would take a conclusion that the taxability will be in the state where the bill to happens and not ship to. We have an interesting question from Yash, which talks about whether a takeaway, whether a pure sale of food items will be treated as a deemed service or whether it will be treated as a supply. Now, to address this issue, of course, while there can be a debate on whether it would be classified as a supply of goods or services, it appears that overall tax incidence on both those products would remain similar. And if that be the case, then I do not see any challenge in terms of classification. Otherwise, yes, the point is very valid that you can still have the situation of complication because of the existence of Article 366(29)(a) being there in the statute book. So we have a question from Levy which says that generally there has to be a consideration, but in case of branch transfers, there is no value, and therefore whether it will be taxable. So as I was highlighting in the definition of supply, we have subclause C, which specifically deals with items listed under Schedule 1 without a consideration. And once you say that there is no consideration under subclause Schedule 1, if you are covered under Schedule 1, you will be covered under the taxation, and therefore branch transfers become taxable. You will have to notionally value your stocks and pay the tax on it with a corresponding credit. So that is. Yash has one more question relating to valuation of branch transfers, wherein we are told that schedule section 15 of valuation talks about a transaction value where supplier and recipient are not related. It does not cover a distinct person. The only challenge which we see in this type of interpretation is the fact that a branch will be treated as a related person, and therefore once there is a related person interpretation, you will end up in a situation that the valuation will have to be at arm's length, and it cannot be a free wish type of evaluation. Of course, some more guidance will be required on this front at an appropriate time. I think that's all we have. Thank you for patient hearing and being online.
Thank you, sir, for delivering such a nice talk on revised model GST law. Before I come to the pleasant task of proposing a very well-deserved and hearty vote of thanks, I would like to make a very important announcement. Our next session of the webinar series on revised GST law shall be on 20th December 2016, that is Tuesday. The topic will be registration, returns and payments under revised model GST law. Speaker on that session will be CA Ashit Shah. The timing of the session shall be changed a bit. It will be from 6 p.m. to 8 p.m. The fees remaining the same. All the members who are interested for this session may log on to the CTC's website www.ctconline.org. Now coming to the pleasant task of proposing a very well-deserved vote of thanks to our speaker for today's session. It gives me utmost pleasure to propose a very well-deserved vote of thanks to our speaker C.S. Sunil Gabawala sir. Friends, everyone will agree that he has taken out immense time from his busy schedule to take us through the nitty-gritties of the model GST law. He has covered the concepts of levy, supply, the various schedules, exemptions and compositions under the revised model GST law. That too, all this analysis in a very short span of time. The revised model GST law made public only in the last week of November. And we are sitting today on 12th December. He has done his analysis, prepared his presentations and delivered an excellent talk. He has done his threadbare analysis on this topic and enriched our knowledge immensely. He also answered all the queries raised by participants to what I can say to their satisfaction. And therefore, I would like to thank CS Sunil Gabawala sir on behalf of all the participants and team chamber for taking out time and spreading his knowledge and expertise in this regard. Thank you, sir, for coming to presenting a seminar. Thank you, sir. Thank you, everyone. We'll next meet on 20th December 2016 for the next series of webinar. Thank you.